Let's move right on then and get on board a fundamental perspective. Mayuresh Joshi, fund manager, Angel Broking, now joining in on the show. Mayuresh, looks like D Street is getting accustomed to these sell-offs, key reforms. It looks like, a setback in that is the key trigger point as to why we're seeing, havoc being wreaked on the street. What's your call?
Afternoon, Avan. I think clearly if you look at the three basic tenets that we were working with, how the monsoon session would pan out, how corporate earnings would pan out, and how the monsoon would fare, I think there have been disappointments on all three. So I think corporate earnings are tad better than what a lot of analysts on the street had expected. A complete washout, it seems, for the monsoon session of Parliament. And again, I think the monsoons itself looking very, very bleak. So domestically, I think things not looking on the brighter side. And again, I think you've got the problems with the yuan devaluation. That is again going to create some amount of havoc, which is already being seen in emerging currencies. Indian currency held on because of the kind of reserves that we've got. But clearly, I think these overhangs will persist onto the market and it will have a lingering effect. So our take that the markets would stay in the range still continues. I think we still believe that Nifty is bound in the range between 8,100 and 8,600.
Mayuresh, what is it that you made of SBI's numbers? Overall numbers look slightly below expectations with the provisions coming in slightly lower, NII coming in a little bit below estimates, deposit growth remains strong.
Afternoon, Aisha. I think that's been the trend with a lot of the public sector banks. The deposit growth has been pretty strong. The lending has been weak. And again, I think conscious efforts to probably look at how the asset quality pans out. So in terms of numbers, I think more or less in line with what we were estimating. So NII in our take was around 18,432 odd crores, which is probably in line with what the numbers have come through. The asset quality pretty stable in our view. The only concern probably would be the net slippages that have come through. And again, I think would keenly hear what the management has to say in terms of the environment generally going forward and the kind of restructured portfolio that the bank is looking at. But again, I think it's a seasonality factor, so you should not be looking in terms of how the provisions have panned out on a Q-on-Q basis. On a year-on-year basis, I think it is still quite decent. But clearly, yes, I think the net slippages have been some amount of a worry for the bank. But clearly, I think numbers more or less in line with estimates. Again, in terms of valuations, trading around 1.1 times price to adjusted book, which we believe is pretty decent. So any further decline, I think it becomes a very good accumulating opportunity for long-term investors in our opinion.
And it just a little view on what the expectation is when it comes to the names from the metals basket, because clearly that sharp fall in the steel prices, there's higher input costs as well. All of that is likely to weigh down particularly on Tata Steel's numbers as well as NMDC. Does the outlook for the metal space as a whole remain rather weak even into the coming quarters as well?
Oh yes, Avan, I think it looks pretty weak, and just a comparative check, I think the hot rolled coil prices in terms of landed costs have actually come down on a year-on-year basis from $682 a ton to around $470. That's clearly going to reflect in how the realizations are going to pan out, both for the Indian and the overseas operations. So again, our take is that Indian realization should be close to $611 a ton, which basically means that the EBITDA per ton will come down drastically on a year-on-year basis. Similarly, for European operations, you're looking to see some amount of pain coming through in terms of realizations. And though input costs have come down, I think the offsetting effect is not going to be that large. Southeast Asian operations again going to be impacted with the kind of dumping that we've seen. And again, I think in the coming quarters with the yuan devaluation, I think you're going to see losses expand, specifically when it comes to Southeast Asia. So clearly, I think numbers expected to remain bleak, specifically in the case of Tata Steel, but gently for the metals pack, I think it's not looking like a very good scenario over the next 2 to 3 quarters. So I think softer numbers expected in terms of realizations, bottom lines not expected to improve. So I think no big upgrades happening. So I think we'll maintain a very cautious stance generally for the metals and mining space.
Right. What about tire stocks, Mayuresh? Because Chinese tire dumping may actually accelerate on the back of yuan devaluation, and you're seeing the tire stocks back home under pressure today.
So clearly, actually, yes, I think that's going to be one key aspect we watched out for, and hearing a lot of management commentaries on the kind of Chinese imports that are already causing issues when it comes to the tire makers in India. We were structurally positive at lower levels. I think JK Tires is something we liked at 85, 86 levels. MRF is something that we liked even before the results. Unfortunately, I think we've hit our target prices in a lot of these tire stocks. And though I think the structural story remains on the positive note for a lot of these tire majors, including input costs going down, replacement market remaining extremely strong, expectations of OEM markets doing well over the next few quarters, aiding the top line growth for a lot of these companies. I think a lot of these issues have largely got factored in terms of the positives getting rubbed on into the price. So I think anything to do further with the kind of devaluation that we've seen and any further imports which come through, I think there will be hits in terms of how the margins will pan out. So I think again we have hit our target prices, and our belief is that we will wait for significant declines before we look at tire stocks again.
What's the call on, pharma, particularly Sun Pharma? I think the Ranbaxy integration this time around might eat into the Q1 earnings. Do you think that the view on some of these key names would be that the underlying fundamentals do remain strong, but there would be some bumps on the way?
Well, yes, I think it's going to be a very lumpy FY16 for Sun Pharma, specifically with the integration issues that it has to face with Ranbaxy. So clearly our expectations is top line somewhere around 86,200 odd crores. We're expecting normalized margins between 24-25%. Our take is that the R&D expenses will be a tad bit higher for this quarter, somewhere around 9.2-9.3%. The bottom line should come around 1,200 crores. So I think it's largely factored in by the street that the numbers will be a little bit better, more or less to do with how Taro's performance has been in the US markets. PAT of $104 million should aid the bottom line for the company and the top line as well. But clearly I think the integration issues will be at the forefront. Halol's incapacities I think will clearly have a toll, and it contributes 10%. And clearly what happens in terms of remedial action being taken on 4 of its plants. So Devas, Tonsa Sahib, Ponto Sahib, I think everything should be watched out very carefully, though the Indian operation should hold pretty well. So I think a 10% growth to around 1,600 crores on the Indian business is not ruled out. So I think we remain positive on Sun Pharma, more or less with a longish perspective. So I think FY16 is largely factored in our opinion. FY17 the numbers should start appearing better.
Okay, Mayuresh, good chatting with you. Thank you so much for taking the time out and speaking with us today. Getting worse for the market right now. We're pretty much around the lowest point in the day. 84.77 is where we're at. About a 0.5% dip. Metals, infrastructure, commodities taking the sharpest knock. IT and PSU banks in particular, though,